This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So there's a lot going on with value stocks now that we're into fall of 2024. We are on the cusp of something good, maybe in value stocks. So it's actually kind of fun to run the screens for the value stocks because a lot of them are kind of hot right now and have momentum. They still remain cheap. And I think this is the start of this next cycle, as I've mentioned before in prior podcasts. So I wanted to look this week for cheap stocks, kind of hidden gem cheap stocks. Number one's, of course, strong buys, because we're just wrapping up earnings season. So now is the time when all of the analysts have gone in. They've made their estimate revisions on the earnings. So we're getting a big crop of new Zacks strong buy stocks. And I'm curious, what is going on with the number ones? What does the analysts see? What is looking good in certain industries. And also then we want to add the cheapness. So for this screen, I looked for the number ones. They had to be over $5 because a cheap stock doesn't necessarily mean a stock that's $1. As we all know, it means cheap on a price to earnings basis, price to sales, price to book, a PEG ratio that's low. Some kind of fundamental has to be cheap for us to want to buy it. So it's over $5 because that just means the professional investors can buy it. They usually don't buy stocks under $5. It has to have over 100,000 in the trading volume because, again, we don't want it where no one knows about the stock. So that's going to exclude some of the more micro cap type stocks, most likely. It has to be the number one, strong buy. And then for the valuation, the cheapness part, we have a PE of less than 20. So it did allow for a little bit higher PE. Many times I look for 15 and under, but for this, because we're looking for another fundamental, not just PE, I'm going for less than 20. And then we're adding this secret sauce, the price to sales ratio. So that's the price divided by the sales. And that has to be less than 1. So as I've mentioned in the past, if you have a price to sales ratio of, say, 0.7, so that's under 1, that means you are paying 70 cents for every dollar of the sales. And that's what we want. We want to get this stock on sale, and we want to get buying either those earnings or the sales as cheap as possible. So the price to sales ratio under 1 will get you that. So running just this simple screen, it returned 32 matches. Now, remember, there's about 230 to 240 Zacks number one strong buys at any given day. It does change daily as those analysts are updating their earnings estimates. We have to run it every day because those estimates are coming in every day on over 4,000 stocks. So there's a lot of stocks in the system, and it's only looking for the best. And what does it mean to get the number one strong buy? It means the analysts are in agreement and they're raising their earnings estimates for this fiscal year. But since we're now in September, it is also now looking at next year's earnings estimate revisions because we're almost done with this year. So it's not going to tell us as much now. And so at this time of year, it's already looking at 2025. So if the analysts are in agreement, there's, at least one, but hopefully several of them all raising estimates. Usually you don't see any cuts with the Zacks number one strong buy. So it's usually we're all in agreement. We're all raising our estimates because something good is going on at this company. Either they beat on earnings or beat and raised full year guidance, or something good happened in the last earnings report for the analysts to be like, hey, I'm behind the, eight ball here. I'm behind the times. And this company is doing far better than what I thought. Or I was pricing in a slowing economy, a slowing consumer, and whoops, that's not what they say is happening. So I have to revise this. I've got to revise higher, or the company is revising higher for the year, or possibly for next year, but it's only September 2024. We're not really getting that much guidance yet for next year. Also, there's a lot of uncertainty out there for all of us, right? The Fed is about to start cutting rates. We don't know by how much, but it does look like they're going to cut this month. So, and the economy continues to slow. Nobody really knows what that's going to mean for the economy, say 3 months or 6 months out. And so everybody's cautious. We're going to hear a lot of cautious things on the next quarter's earnings that start in October. And we're also going to hear about uncertainty, and especially about the coming holiday season, anything that's consumer oriented. So there are a lot of things going on, but it still says a lot that these stocks, these 32 companies, have the number one rank, the strong buy. Something good is happening. They are raising those earnings estimates, and it remains cheap. So that's key for us. We want it to be cheap, but 32 was a lot more than I expected to see. But that's what I mean by value, being kind of back. It's back. That's all we'll say, because growth has sold off. A lot of the speculation in the market, a lot of the exuberance has retreated. And I know what you're thinking. It hasn't on NVIDIA or Eli Lilly or, name some other really hot stock that's trading at like 100 times. But for the vast majority that isn't in that little small select group, they have come back down, and valuations are looking a lot better. And because value has been out of favor for so long, the value stocks are cheaper than ever, even though some of these are trading at new 52-week highs. So I took a look at only 3 stocks on this week's episode because I kind of wanted to see what was going on. The screen did return a lot of stocks that were not well-known names. And so you have to dig in a little deeper. You actually have to find out what they do, how they did last quarter, what they're saying. Did they raise estimates? Are they seeing good things going forward? You have to dig in and look at their earnings reports, maybe some presentations that they reported out, or maybe listening on their conference calls to see what's happening. But that is the nature of value. It is ignored by the street. So you have to do a little bit more deeper dive. So let's dive right in ourselves. So the first company that I looked at was Assurant. Ticker A as in Adam, I, Z as in Zoo, AIZ. And I thought it was an insurance company, but it's interesting when you go to their website, it doesn't really say that. It says it's risk management, but this is what they describe themselves as: global business services company that supports, protects, and connects major consumer purchases. So, AKA insurance of some kind, I believe. So they have global housing and global lifestyle are their 2 main divisions. They did in the second quarter, that was here in August, they did raise 2024 enterprise outlook, and things look pretty good. They have a share repurchase program going, and they expect to repurchase at the higher end of that program. 200 to 300 million is the current program. So that's not too small. This is actually a large cap company. That's the thing with some of the insurers. You might not be as familiar with them, but they're bigger than what you think of. And this one has a market cap of 10.2 billion. So that is pretty big. That is a big cap. PE is just 11.9. So that's well under the 20 level. that we were screening for. It's obviously Zach's number one rank. Price to sales ratio is 0.88. So we like that as well. Dividend, they do pay 1.5%. You might imagine for insurance companies. Year to date, the stock is actually up 17.1%. That's right around in line with the S&P 500. So, it's kind of tracking along with that. But I'm looking at the chart now. It has busted out now to year-to-date highs. It is at 52-week highs. And over the last year, shares are up almost 41%. And that is well outperforming the S&P 500, which is up about 24% in that time period. On the 2-year stack, it is underperforming. It's up only 24%. But again, that is because the value stocks were out of favor. If you're going back all the way into 2022, even in parts of 2023, they were still mostly out of favor. But now times have changed. Insurance is in. That's why Berkshire Hathaway keeps hitting new highs. It's big in insurance as well. So again, Assurant, AIZ is the ticker. Earnings expected to be up 6.8% this year and 6.1% next year. The analysts have been raising that's why we get the Zach's number one rank. And they themselves raised their 2024 enterprise guidance, like I mentioned. So they also, on the style scores, have an A for value. They have a C for growth, an A for momentum, and a composite score, which is VGM on Zacks.com, of B. A is the highest. And obviously it's like grades in school, right? A, B, C, D, and F is the lowest, but no Fs for them, not at all. And this stock looking very interesting. Like I said, value stocks suddenly in favor, but nobody's really noticing yet. So that's Assurant, ticker AIZ, if you're looking around for an insurer. Okay, the second one, I tried to pick like a technology. I'm pretty sure we've talked about this one in the past. I'm almost positive. It's called Synchronos Technologies. Synchronos. And it's ticker S as in Sam, N as in Nancy, C as in cat, R as in Robert. SNCR. And they are a global leader in personal cloud. So what does that mean, personal cloud? So if you're a company that has a lot of customers who need cloud, so that would mean like Verizon, AT&T, somewhere where you're storing data or your photos on your phone, for example. You might have AT&T on your phone and you need cloud storage. Those companies need to provide it somehow, and they go to a company like Synchronos Technologies. Now, also interesting in their list of companies who use them was the company we talked about just a moment ago. Assurant is one of their customers as well. They have 10 million plus registered subscribers now for their software. That's what it is. And they are cloud only now. So they've been making a transformation of the company from several different divisions. They used to have messaging and Network X business. Now they're only solely cloud. And in the second quarter, revenue was up 6% to $43.5 million. 90.5% of that was recurring revenue. And that's what you get when you have customers who are just subscribers. And that's common with software companies. They have great recurring revenue because people need whatever that software is. They subscribe to it, and then you just get month over month, they're paying for it. Company also retired the company's preferred stock, and they reduced the total net debt using a new $75 million term loan facility. So a lot is going on with this company. That's why I remember talking about it, because the last time I talked about it, these things were all in motion, but they hadn't really completed yet. In the quarter, they had $7.6 million in free cash flow. So I'm liking that. And the earnings have really turned around on this one. And that's what gives it the Zacks number one rank and why I was interested in it. They not only have the Zacks number one rank, they have style scores of A for value, A for growth, B for momentum, but an A for VGM. That's the highest. So they came within a sliver of having a perfectionist on both the Zacks rank and style scores. But again, it's kind of been a turnaround story for a number of years now. And last year they lost $1.41. This year they're expected to make $1.19. So that's where the turnaround is. One estimate is higher in the last 30 days. Nobody is lowered. But for next year, 2025, which the Zacks rank is now looking at, two estimates are higher in the last 30 days. And that includes this earnings report. So prior to the earnings report, analysts were at 35 cents, and now they're at $1.15. So that's a big turnaround. That's a little lower than what's expected for this year. So we'll have to see what happens with those earnings. But this is a small cap. I would almost put this in a micro cap, but it trades with enough volume that it did make our screen, but it has a market cap of only 153 million. So it's very small and not really followed heavily, but we do have two estimates on it. So that's good to see. Now, what are its valuations? PE of 12.4, price to sales of 0.87. And here's what's a little bit of a shocker. So now that the turnaround is being talked about and looks to be happening, especially where earnings are concerned, with that big earnings, they had a big earnings beat in early August. The shares are now up year to date 127%. So we're not getting in at the very bottom of the turnaround, but the Zacks rank is showing us the stock still fairly early in this story. And I'm just kind of looking to see, like, what did it do in the last month? Yeah, since that earnings report, which was about a month ago, shares are up 41% off of that. So you might want to wait for a little bit of a pullback here because it's likely to see one, because we are now at the 1-year high. And let me see, going out, it's even the 2-year high now that things have, are working themselves out on these ones where they have the strategy and they're doing the turnaround. And now they've taken out the loan, they've reduced the debt, they paid off the preferred stock, all the stuff is done. Now everybody's getting in and the street is liking it. So that's Synchronos Technologies, SNCR is the ticker. Okay, and then the third company, I had not heard of this one either, and I just kind of picked it because the name was interesting. So it's LSI Industries, ticker L as in Larry, Y, T as in Tom, S as in Sam. So LYTS, LYTS, though, as the ticker, because they make commercial lighting and display solutions. They're in Cincinnati. They have 1,900 employees across 16 facilities. I like manufacturing companies, and I like these ones that are in niche areas. So in the second quarter, it was this fiscal year, fiscal fourth quarter is what they reported in recently, and they had for lighting, their lighting segment, they said they experienced generally stable demand conditions across most of their vertical markets. And display solutions sales were up 22% in that segment, but that also included a big acquisition that they closed on a couple months ago. But they did say momentum to continue into 2025, which they are now starting. So they're now into fiscal 2025 because they're on the fiscal year. For fiscal 2024, they had full year free cash flow of $38 million. I'm liking that, because they are a small cap, market cap of just $457 million. But they had, as of June 30th, 2024, $50 million in cash and loan availability. So they're doing good on the free cash flow and just with cash on hand. So I thought, they've got to pay a dividend, right? And they do. It's yielding 1.3% right now. So that's always good to see a small cap company paying a dividend. But this is old economy, right? Commercial lighting and display solutions, even though this is like, I'm sure, sophisticated work that they're doing because it's on the commercial side. So think of all the areas you need commercial lighting. I think they even said they did refrigeration. So every time I'm opening up that refrigerator, there's a light in there, right? So sounds like these guys are making that kind of item, and that's very specific. So year to date, it's up 12.7%. It's not at the highs, and the stock is really choppy. So that is going to happen with the small caps. They're not as heavily traded, or people don't really follow them. And if the small caps are out of favor, then the stock will basically sell off when the Russell 2000 does, even if nothing's going on. But when the small caps are in favor, that's when you get big rallies in stocks like this. And so keep that in mind if you dive into any of these small caps, because it takes like another level of strength. You've got to have a strong stomach to be in the small caps. But once we do get a legit rally in them, it's going to be pretty intense, I feel, and it'll be easier to buy, obviously, because we will be in rally mode instead of the bearish mode we've been in for basically about 10 years. So I'm looking at the chart on LSI Industries. So the 2-year stack, it's up 101%. But over the last year, it is up not hardly anything, or it's down, actually. It's down about 0.6%. So not even a percent, just kind of hanging out and moving up and down, waiting for some kind of, catalyst or something. So with this type of stock, you might want to wait for a sell-off again. It has gained in the last month as well, but not a lot. It's up about 2% only in the last month, but it has seen the up and down trade over the last year and even year to date. So you might want to wait a little bit on this one. So what do the earnings look like? So fiscal 2025 earnings expected to be up 6%. And the analysts, again, have been raising on this one because this last quarter and for the fourth quarter was so good that things look bright going forward here because the company is saying so. So you got to like when the companies themselves are not seeing the slowdown at all. And, despite everyone saying we're in the slowdown, a lot of these companies are not seeing it. Now, we only have one estimate on it on Zacks.com because it is a small cap. It's on manufacturing side, old economy, so not as highly followed. But this fiscal year, expected to see 88 cents. That's up 6% from last year where they saw 83 cents. And it's also up 8 cents since 30 days ago, since before they reported. So the one analyst on this was a little too conservative for next year and did raise to get more in line. Fiscal 2026, I'm not sure why it's supposed to jump 34%, but the estimates are up for that year as well in the last 30 days to $1.18 from $1.05. So we had 83 cents last fiscal year, 88 cents expected this year, $1.18 for next year. Great free cash flow. Cheapness, we didn't discuss that yet. PE of 17.8. So that's a little bit higher than some of the others, but within our scope of our screen. Price to sales of 0.97. So almost at the dollar. So we're not getting it as cheap as some of the others. Like I said, if it pulls back a bit, 5%, maybe even 10, if we get a 10% pullback, then we're getting it a lot cheaper. And that could be where you might want to get in on a stock like this. So that's LSI Industries, ticker LYTS. And remember, the Zacks rank does find hidden gems. It does find these companies you've never heard of, like a Synchronous Technologies with that small market cap of 153 million, or an LSI Industries that you may have never heard of as well, unless you're in Cincinnati, where you might be familiar with it. So use the Zacks rank whenever you can. And if you aren't a premium member where you can get access to it easily, definitely listen in on these podcasts because I'm always talking about it here. I'm talking about it on the Market Edge podcast every week as well. And you can also get our Bull of the Days every trading day on Zacks.com. Just go on Bull of the Day. It's going to be a Zacks #1 rank stock. And you can even check out the Bears of the Day. You get some interesting ideas in the Bears. I should do a whole episode on cheap Bears, Bears stocks, because while it is a Zacks #5 strong sell because the analysts are cutting their estimates on those, sometimes you can find a turnaround story in there where it looks kind of grim right now, but it may not 6 months or a year from now. Because remember, the Zacks rank is that short-term recommendation of just 1 to 3 months. It's constantly changing as those analysts change their earnings estimates. So they might be cutting now, but a year from now, when that turnaround is complete, they may be raising and it's going to get the good Zacks rank. So I do like to look at the Bears myself, but you can get both. Just click on the Bull of the Day or the Bear of the Day on Zacks.com and check out our top stock picks of the week. That's a video we do every week, and those always show 2 Zacks #1 rank stocks as well on that video. You can find it on YouTube. Go over to Zacks.com/YouTube. It says stock of the day right on the video, and find out some more Zacks top rank stocks there. So plenty of ways to get the Zacks rank, even if you are not a premium member and you cannot access it completely on Zacks.com. Still many ways you can get it. So you want to deploy it as much as possible because you can find these excellent hidden gems like we did today. So what were they again? We had Assurance. That's the insurance company, ticker AIZ. We had Synchronos. I keep thinking I'm saying that wrong, but I'm not. Synchronos Technologies, ticker SNCR. Then we had LSI Industries. That's the lighting, LYTS. And as always, I aim to bring you all the cheap stocks every week, and there's plenty right now. So be sure to subscribe to get all of the Value Investor podcasts. You can get us on Apple, Spotify. You can also get us on YouTube on the Zacks podcast channel. We have our own podcast channel over there, but just put in Zacks podcast. You'll find them all there, and you can subscribe there. But be sure to get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.